Uncertainty in the market about inflation, the path of interest rates, and the long term effects of Omicron saw investors sell equities ahead of the final Federal Reserve interest rate meeting of 2021. Investors have also been focusing on the S&P 500's largest constituent, Apple, which is getting near to a market cap of $3 trillion and which is increasingly becoming the major driver of the S&P 500's performance. Apple is up by more than 31% year to date and by 43% over the last year, and the stock has added approximately $1 trillion of market cap in just 16 months. That rise means that the S&P 500 and the SPY ETF are becoming less diversified as the impact of Apple outweighs moves in the majority of stocks that make up the index. And that could become a headache for many investors going forward. Apple's dominance could ultimately mean that funds flow out of SPY and into, say, the equal weight S&P 500 ETF, which trades under the ticker RSP. The ARK Innovation ETF was under pressure once more over the last week and has been showing up in data that tracks stock borrowing, a process that allows institutional investors to short sell a stock that they don't already own. The recently launched Tuttle Capital Short Innovation ETF, or SARK, which takes short positions in the stocks that ARK Innovation owns, has made monthly gains of 22.41%, underlining just how tough it has been to be long of many technology and growth stocks in recent weeks. TLT, the 20-year plus U.S. Treasury bond ETF, marked time over the last week as bond investors sat on their hands ahead of the Fed's December meeting. If we look out to July 2022, then almost 88% of traders think rates will rise in that time frame, according to data from CMEgroup.com. The yields on the 20 and 30-year Treasury bonds fell last week, which could suggest that money coming out of the equity markets was looking for a safe haven, at least until the U.S. Central Bank had made its decision. ETF fund flows data shows that bond-related funds, including TLT, absorbed 32.5% of the new money coming into ETFs last week. USO, the U.S. Oil Fund ETF, fell last week as crude oil prices retreated. A warning from the oil trade body, the IEA, that Omicron would likely reduce demand for oil in 2022 weighed on prices in futures markets, suggests that traders believe an oversupply of oil could persist throughout the first quarter of next year, not helped by rising U.S. crude oil production. The U.S. Energy Information Administration is predicting production of 4.95 million barrels per day throughout December and higher numbers in January. XLV, the S&P 500 healthcare sector ETF, rallied last week, and when looking at technical indicators, like the percentage of stocks within the healthcare sector that are trading above key moving averages, we expect to see a pullback or drop in performance from XLV in the run into the new year.